Hi, morning everyone. This is Wee Kwang. Thank you for joining us for Philip Research Morning Call today. So today for the call, we have IX Biopharma initiation, and then we will be followed up by Keppel call, and then we have Singapore Technical Outlook as well as a summary of our SG fourth quarter equity strategy. So without further ado, let us begin with IX Biopharma's initiation. Okay, next. Okay, so just a brief background. I know this is a company that people might not understand a lot, so feel free to ask questions and I'll try to answer them along the way. At the end of the presentation, sorry. So to begin, we initiated a buy call with IX Biopharma at a target price of 45.5 cents. And the company basically was listed in SGX as Catalyst Board in 2015, and its principal business includes the development, manufacturing to the sales of pharmaceutical drugs. So generally, what you see is that on the table on the bottom right, you can see they undertake the entire range of business activities, and most importantly is that it was very focused on R&D previously. And right now they are moving towards the sales and marketing side. So they are commercializing their business model. So their business segments includes specialty pharmaceutical drugs, as well as nutraceuticals, which is your health supplements. And generally, they have a main operation in Australia from manufacturing plant there, and then they sell directly to the healthcare industry in Australia itself. And now that they're expanding, they are already having footprint in Singapore and China, and they are looking to have some licensing deals that are in China and Europe, the European Union as well. Next. Okay, so what is the key thing behind IX Biopharma is this Waferix technology. So it is a patented sublingual delivery system for drugs. So if we look at the bottom right table again, traditionally we have drugs that are either administered to your body intravenously, which is directly through an injection, or you eat a pill like a medicine. So right now, what they have come up with in recent times is that they found out that actually putting a drug underneath your tongue and letting the active ingredients go through the blood vessels that is under your tongue is actually a faster way compared to your orally ingested drugs. But although intravenously through the injection is always the fastest, definitely, because it's directly into your blood. However, the problem with intravenous administration of drugs is that it requires medical expertise. So you can't just inject yourself with a drug. Usually you need to go to a hospital setting, and this creates a lot of inconvenience for a lot of patients, which can be bypassed with if you have a sublingual drug or an oral drug. So what Waferix technology does is that it has actually been tested and proven to show that it helps facilitate the sublingual delivery. So through the tongue itself, it is actually a faster delivery of drug as compared to typically out in the market when you see other drugs that they say, oh, you just put it underneath your tongue. Some of it might not be, formulated or manufactured specifically for the drug to be absorbed through the blood vessels underneath your tongue. Yep. And then apart from the formulation itself that makes it so new in the market, actually the production procedure behind creating this sublingual wafer itself is actually very quite like secretive. Like it is part of their intellectual property. So what they do is there is a freeze drying procedure. I'm not a scientist myself, so I don't really know the details, but this is what is something that's not replicable by anybody else in the market because they don't know how it is being made. So for them, the attractive points, first of all, is that upcoming, the most in the short term itself, they have this Wafermin product that is currently sourcing for out licensing partners for the phase 3 clinical trials and this Wafermin is actually a ketamine wafer. So it is actually used for treatment of acute moderate to severe pain. So usually something like post-surgical. So having a big surgery and then you use it as a painkiller. And because the safety as well as the effectiveness of this ketamine Wafermin itself is actually tested and proven in the phase 1 and phase 2 of the clinical trials. Actually, the phase 3 itself is there's a very high likelihood of success, meaning that because they are just trying to replicate the phase 2 results of safety at a much larger scale across population. And furthermore, what we know is that when we try to, of course, we try to value this deal, we don't know how to, it's very hard to value, but we see that actually, right, the fact that their phase 3 clinical trials is currently valued at about $25 million USD in terms of cost itself, what the potential deal itself will definitely outweigh the cost, so that they will be able to get. But of course, with an out licensing partner, this $25 million cost will be undertaken by the partner itself. And we see from a typical out licensing deal, if you look at the table on the bottom right, you can see that once a deal is signed, they will have an upfront fee, and then within 12 to 18 months, the likelihood of the phase 3 will complete, and then depending on the success or failure again, then there will be another fee coming in, and based on the approval, marketing approval and launch itself, will be furthermore more fees coming in, spread across the next 2 financial year. And after everything is done, when they actually license it to sell, they will have like sales milestones. So every X amount of sales that you get, they'll get a portion of it, and a royalty fee for having the license every year. So this gives, just for WaferMe itself, which is one product, a very high margin business kind of. Course, it's totally free just in licensing fees alone. Secondly, the next investment thesis for them is that they actually have a planned production capacity increase by the second half of the financial year of 2021, which is from July to end of June, next year, end of June. So what we saw was that actually in the past quarter itself, the fourth quarter, meaning April to June, the company actually saw very strong sales of about $560,000, which actually made up of 57% of the entire financial year 2020 revenue. And this was on top of the fact that they were hampered by some capacity restrictions, because previously they were focused on R&D, and now they are only slowly beginning to ramp up their production capabilities. And what we see is that in financial year 2021, meaning starting from next year onwards, the second half, they will increase this capacity by 6 times. And if you just do a simple math, you know that the revenue forecast that I provided is actually on the conservative side of this increase in capacity. So what we are expecting is actually for revenue to increase by 250% for the financial year 2021. So meaning ending next year, June. And lastly, the most interesting thing for them is this WaferX technology, right? And it offers up a lot of potential for them to undertake future drug development projects. So what we know is that unlike, say for example, you have a new drug out in the market, say for example, a vaccine, you need to test whether the drug actually starts to work. But because the WaferX technology is not like a new drug, there is just the delivery system of underneath going through your tongue. What happens is that the drugs that they are implementing it on is most of them are already tested. So what happens is that it's usually the R&D process is much shorter. They don't need to test for the effectiveness of the drug itself. They just need to see whether it is faster as compared to a typical drug delivery through orally delivered. And then this gives lower cost and lower risk associated with drug development. And this will help them to gain a lot of potential into many, many segments within the pharmaceutical industry. Of course, there are some risk and mitigations involved. First of all is that there might be a delay in out-licensing agreement. But what we do see is that because actually end of their phase 2 and it was actually completed last year, so 2019, and as of since 2019 end of the year, they were already trying to source for a potential partner for their phase 3 study. But of course, because of all the pharmaceutical industry, they are all channeling their resources into finding a COVID-19 vaccine currently. A lot of time and resources are taken away. So not many people are focused on pain management now. But then of course, it is still high on the priority list to develop a effective pain development drug out in the market. What we see is that we think that an out-licensing deal will be very soon, maybe within this financial year itself. But even without, it will delay their profitability from financial year 2021 to 2022. Loss in demand. Okay, so the main thing that we mentioned previously also was that there is a high demand, which is key to their turnover and letting them become profitable over the next 2 financial years. Okay, so this is, of course, we think that this is mitigated with their WaveRix technology. It is not easily replicable, but we can't really, I mean, of course, there's a lot of plans to undertake a lot of sales, go through a lot of sales channel, and we are just looking for it to play out. But generally, we think that the loss in demand will not be very likely as well. And lastly, there's some currency translation risk. Bulk of their operations is in Australia, from manufacturing to the sales currently. And currently, with an expansion in plan for EU and China, they will see some greater currency risk exposure in the near term. Just some financial forecasts and highlights. Revenue, like I mentioned, we see that generally over the next few years, we're forecasting a 250% over the next year, and into 2022, financial year 2022, we are expecting about 200+% increase as well once their capacity actually stabilizes. And they do have plans to further increase their capacity even in financial year 2022 as well. And the increase in their production capacity will help to turn their negative gross profit margin around. So if you see the graph on the right-hand side, currently I think that is negative 50% gross profit margin. That's because they are not producing enough sales. But once their sales break even and they start producing more, you'll see them go back to a healthy level of about 70 to 80%. That is roughly the industry level, the industry average that we are seeing. And this will also negate some of the high expenses currently. So they have high R&D, sales and marketing and general and administrative expenses that is now currently at a higher level than their sales. But when their sales go up, that's why we think that you'll be under control. So generally, our valuation is done on a discounted cash flow model based on a weighted average cost of capital of 10% and a terminal growth rate of 2%. So we initiate IX Biopharma with a buy call at a target price of 45.5 cents. And that's it from me. I'll now hand the time over to Terence for Keppel Corp.
Thanks, Wee Kuang. And good morning, everyone. We attended the briefing conducted by Keppel Corporation, where they provided more details for their Vision 2030 plan, as well as the commencement of a strategic review of Keppel Offshore and Marine. So in this slide, we cover the summary of the key takeaways from the Keppel meeting. Do take note that we do not currently have coverage of Keppel. So we provide so this is non-rated. So the summary of Vision 2030 is that Keppel Corporation has identified a total of $17.5 billion of assets that can be monetized over time. In our table below, you can see a breakdown of these assets that Keppel has identified to monetize over time. So the $17.5 billion is spread across their different asset class and include their current substantial land bank that they hold, projects under development, non-core assets, and other fund or investments that can be liquidated over time. It is important to note that the $17.5 billion is the carrying value of the assets as at 30th June 2020, which means their first half 2020 results. This means that any upside in the sale price of these assets will be an added plus for the group. I think it is noteworthy that the land bank that the Keppel Corporation hold, you can see here on the table below, 7 billion that they identified, including projects under development, are held at historical costs. And over time, what we have noticed is that the land bank the Keppel Group hold in countries that they operate in, China, Vietnam, and India, this land bank, the value of the land bank has increased over time. So so if they are able to realize and crystallize the value of these assets, this will be positive for the group. No timeline was provided for divestments. For those who are familiar with the Keppel Group, you all will know that divestments of assets and the monetization of assets are part and parcel of the Keppel Group business. But what we think is different this time round is that clearer targets were set in the monetization of these assets. You can see here they've identified 17.5 billion. So we think the clearer target set will be positive for the group. And even though no timeline was provided, except that they're supposed to accomplish this by 2030, we know that $3 to $5 billion of divestments are expected within the next 3 years. Concurrently, Keppel Corporation has also commenced a strategic review of the Keppel Offshore and Marine business. What we understand from the Keppel management is that the review is in the early stages, so they have not reached any conclusions yet with regards to what they want to do with the O&M business, but all options are on the table. And of course, if you remember, this strategic review of Keppel O&M comes at very, very hot on the heels of the withdrawal by Temasek just 2 months ago. So we understand that Keppel is currently in talks with their largest shareholder, Temasek, in terms of what to do with these assets. So we think it's positive, but as to when this strategic review will be completed and what they will do, I think it's still early days. But we will provide you with more details once we have them in terms of the options for the O&M business. I'll now hand over to Wei Ren, who will cover the technical outlook. Wei Ren, over to you.
Right, thank you, Terence. So today I'll just cover some of the STI. I think STI overall, not much changes from since last week. And then overall trend is still on the bearish downside based on the wave theory. Nothing has changed unless a subwave of wave 3 at in the invalidation level at 2574 to 2006 is being invalidated. Then we will see a prolonged wave 4 going on. What do I mean by that? Because as you know that wave 4 already cast in stone, set in the chart by me. Okay, but that's if the wave 3 invalidation level is being broken, means that either price move up higher or closes at above 2006 and then or even at 2007, then there's a possibility that wave 4 will be evolving into a corrective flat, means that there will be a 335 corrective flat pattern. I think if you would like to know more, that you can drop me an email. I can explain it to you in full. All right, so the daily chart, which is the next slide. Okay, the next slide is despite 2005 being supported, and then last Friday it being broken after Donald Trump announced that I got COVID, so price actually have a drop in intraday, and then after that, before the market closed for the week on last Friday, price actually did recover thereafter. Although this morning, as of now, is trading above the resistance, means that it actually gaps up. But currently, after it gaps up, I think intraday there's some hinges of selling off. So it either says that the participant or the market is not very confident in the STI outlook, in the bullish outlook. So therefore, I think that the best case scenario that we have is that price is going to test the lower bound of the support zone 1, which is around 2003 to 2000, the higher end of 2003 to psychological support like 2004. Otherwise, longer term, I'm seeing a rebound at support zone 2, which is between 2002 to 2245. All right. So next slide, I'll be sharing about I add on Keppel Corp. So if you have read my report, I initiated a selling. The sell down is actually in conjunction, in confluence with the overall dominant trend. Since 2016 onwards, I think many of you know that Keppel Corp has been on a very technical downtrend. It makes a series of higher, lower low, lower high, lower low, lower high. And until now, recently it just in August, it just break below the 2016 low. Okay, so therefore I'm still maintaining my short despite despite what Keppel Corp shared last week, I think which was covered by Terence earlier on. Price did have a strong rally. I think it was one of the strongest rally that we have, because it formed a gap up. But of like as of last Wednesday, I think price rejected at the resistance selling zone at 38.2% of the swing low. Is a Fibonacci retracement. and then followed by a gravestone doji, followed by a doji, and then a strong bearish candle down below resistance selling zone. Okay, this resemble like a evening star, but is theoretically not really a evening star. So based on that, I think we are looking at potential rebound at $4.09 to $4.11, which is highlighted in light blue. And I think if you can look at is the RSI. RSI is showing a slight turn below 60 resistance level, although it's not the oversold region above 70 or 80. But this resistance level is crucial because it shows that the momentum is is following the trend going forward. All right. So next slide will be SGX. I think SGX is very strong. I think we're going to share it later on the fundamental outlook, and then why we are adding into the absolute 10 portfolio as well. So based on technicals, is fully support everything. All right, so since SGX has broken out of the inverted head and shoulder, which was published in I think July, okay, the report. So we have seen a strong further upside as well. All right, so despite SGX having a strong sell down today, I think current price is around current price is trading at 911. I think intraday is already rebounding. Okay, in the hourly chart. So we are seeing a further upside. All right, and then look at the overall picture. We are seeing a potential wave 3, extended wave 3 of the minor phase. Okay, so target wise in the midterm, we are seeing above $10 as well. Okay, so that's all for IGX. Move on. Top Glove, next slide. So Top Glove, I expect a prolonged correction ahead. First of all, I think based on the wave theory, I think since I mentioned in my report before on the subheading, the price failed to break above $3 or $3.10, then we are facing a potential of any tree, potential of double tree corrective flat, which you can see in the which I clearly mark out the setting already. Okay, so another thing is the Top Glove. Okay, the resistance zone between $3 and $3.10 has been tested twice, so it actually gave us a hope that that actually not a hope, it just give a sense of like a reading of Top Glove that is currently is going to make higher of definitely, but whether it will break above the invalidation level, which I put on a mark over there at $3.28, is actually a question mark. But I think that it's not going to break any higher. It's not even going to break above $3.10, and then subsequently it will form a ABC zigzag down, and then the support zone will be between $1.77 and $1.30 region. Okay, so the next slide I will share about is similar. Okay, but instead of using a double tree, I use expanded broadening wedge formation, which confluence, which also conjuncture with the elevatory as well. So instead of that, it will be a five-way broadening wedge triangle, wedge pattern. Sorry. Okay, so same thing. It has an invalidation level. Invalidation level still stays the same as of the double tree early on. So pennant, it has a Top Glove is actually has edge higher today, but it's forming like a doji-like pattern in the daily chart. So it's quite kind of risky for now to say. So based on the lower momentum that it actually break out of the pennant, but I think that even if we make a next few days is going to make an upside, I think is going to reverse down exactly to form wave E upon touching wave D. Okay, so Top Glove, unless it break the invalidation level at $3.28, otherwise I think that Top Glove is going to go for a prolonged correction. All right, so next slide, please. So Mapletree is also quite strong. So Mapletree, I think let's look at the wait, let me pause. That's in the okay. So Mapletree intraday has been up. It's at $3.28 now. Chances are that I think if you look at the weekly wave chart, I think wave 5 is kindly going to make higher high. First of all, although price has shown some significant reversal pattern, candlestick pattern at 123.6 extension level of wave 4. Okay, but I think that price is going to make a higher end up to 161.8%. All right, so I'll show that why I think so, because because the sub wave of wave 5 is not yet complete. So the next slide. Okay, so in the next slide actually has shown that the 5 wave has already been completed. So A, B, C. I mean the 3 wave out of 5 wave, the wave 1 to wave 3 has been completed. So actually the wave 4, okay, which is ABC after wave 3, is forming a regular flat corrective wave. So chances are we are looking a prolonged correction, short-term correction to support zone 1. All right, then therefore after that, then there will be a rebound. So should $3.37 be broken, then we will see intraday up to premature up to $3.75. All right, so next slide. So that, I think next slide will be AEM. This will be my last slide. Okay, so AEM holding, I think if any one of you have joined my last Tuesday with the SGX webinar with Jeff Howey, I mentioned that if AEM fails to clear above the resistance zone, then wave B will be cast in stone. And true enough, it formed a reversal down below the resistance zone on the weekly chart. So therefore, I think that wave C is AB out of the corrective wave ABC. I think wave C is on the way. And then once wave C is being completed, then we will see a rebound back up for AEM. So if you can see next slide, okay, I think price is still trending lower at $3.55 now. Is poised to break below the bearish flag again. All right, so I think the support zone confluence with what I shared in the weekly chart. So therefore, I'm looking to long on the upside once price already touch the support zone. Okay, so with that, I pass more my time to Paul.
Thanks, Biren. We'll now just discuss our strategy that we did on Saturday. So those who did attend, please don't switch off. I think what we're going to do is just a quick summary of our strategy for fourth quarter. The reason why we have this title bottom but a slow grind, basically that's how we view the economic conditions right now. After the initial snapback that we got, when lockdown was imposed and lockdown was removed, obviously the economy will rebound. But thereafter, what we see, at least on a year-on-year basis, will be a slow grind or a slow climb upwards in terms of the economic momentum. I'll move on to the next. Okay, and then we'll just run through some of the macro themes that we see for this for the fourth quarter. I think the first, I think we are no stranger to this chart. We always give it, we always display every week. So these are the new cases. I guess the only reading from this is that as whenever you have new cases, what it means is that it's just going to the continuous spread of this pandemic means that there'll be it will just stall any economic momentum, because as what we're seeing in Europe, cities have to lock down and reopen and lock down. So obviously it's going to kind of stall a bit of the economic momentum that's underway globally. If we continue to see this pandemic as such continue to reach new record levels. Next slide. I think this is nothing much. We showed it this just to show you that the second wave is even worse. So I think now in UK, which is the red line, is actually hitting new highs. Likewise for France. Next slide. Singapore is positive. I mean, it's positive that we only have one community case. And also, as we've seen from the last few days, I think the group gatherings have increased. Cinemas used to be kept to 50. Now you can even go as much as 150. For religious worship, I think the number of the crowd is from 50 to 100. And you, of course, weddings can go hit to 100. So you can see that the positive for Singapore economy, at least, that things are starting to improve, but not the borders. I think international borders is still very restricted. It's only mainly for business travel and very limited. And if anyone who travels, you're still going to get to quarantine yourself. Okay, the other theme, sorry for the quality of the picture. I think this comes from the Federal Reserve itself. So the other theme for the fourth quarter, of course, is interest rates will remain low. I think even the Fed basically do this as the way to guide investors that they're not going to raise rates. It's almost like part of the way they conduct monetary policy now. So from the table, if you want to count, there are actually 17 dots there. Just to recap, the people who actually put these dots are the 5 on the Federal Reserve Board and then the 12 Federal Reserve governors. So basically all of them are saying that they're not expecting any rate increase until after 2020, maybe 2024 onwards. Obviously, these things can move. I think unless interest rates start to spike up and economic growth start to surge better than expected. But if everything goes according to their forecast, no rate hike until 2024. Okay, next slide. Okay, so if you want to predict, if you want to see how interest rates will be, I think there's only one chart, and this will be the chart. So, so there are two conditions, there are two checklists that the Federal Reserve basically said before they raise interest rates. The more important will be inflation. They use core PCE. I mean, you can use core inflation. I mean, it's more or less the same, just the basket a bit different. So what they're just saying is that it has to be moderately above 2%. So the blue line has to be above the red line, must be above, number one, and it has to be also for some time. Don't ask you how long is some time. They never really say. But I think some interviews made is that they think interest rates, I mean, inflation needs to hit at least 2.25, 2.5, then they need to consider thinking about raising rates. And so until you cross that then only will start to worry. But if you look at the yellow line, the orange line, this is like the 12-month moving average. So you can say that on the longer term basis, it has actually never crossed the red line. And with the economic conditions this way, it's unlikely, at least at this juncture, that inflation can actually beat their expectations. And the other requirement is that there needs to be maximum employment. So right now, the unemployment rate in the US is 8%. So you need to hit at least 4% before they also consider looking to raise rates. So yeah, okay, next slide. Okay, the other theme underway is, of course, the vaccine. There is a high chance, I mean, if you look at just statistics, of course, this is not a medically, I can't medically tell you that it's going to happen, but just looking at the numbers, if you look at this chart, so what it tells you is phase 1, then 27 applicants, phase 2, 14, then phase 3, there's 11. If you look at our slides about 3 months ago, phase 3 was only 3 applicants. So you can see the number of people, the number of companies entering into the phase 3 trials, which is the multiple thousands of patients that they will test, is really 11. So why we think, the two reasons why we think the likelihood is near is, firstly, there are more than 180 companies applying for a vaccine. I mean, doing research or doing clinical studies, or at least preclinical. Then already 11 has gone to phase 3. And the second reason why we think is that the US government at least has done, what they have done is they kind of de-risk. So if you look at the first bullet point, it takes 5 to 10 years, and also the failure rate is 93. So every 10 vaccines that is from preclinical to trying to get a licensing, 1 in 10 fail. But the government knows that, and what they've done is that they'll try to pre-fund you. So who wants to raise 500 million to 1.5 billion for a vaccine when like 1 in 10 times, worse than Baccarat, so 1 in 10 times that you will fail. So, but what the government says is, okay, we will do this Operation Warp Speed. We will pre-order from you, let's say Moderna, I think it's a 1.6 billion deal. They'll tell Moderna, I will just buy ahead 1.6 billion from you, I think 100 million dosages or whatsoever. And then I will fund you, I will pay you to help develop the thing. If there's a failure, then the risk is with the government. So if they can't get the product up, then the government will be the one who will take the loss too. So as a result, they're pre-funding a lot of this development, which is helping the demand. So there are that's why we think there are 2 reasons why there's a high chance, but it doesn't mean the vaccine doesn't mean vaccination. It just means it's done, but vaccination could take months or even a year away for mass vaccination. Next slide. Okay, I think the elections, I think we'll talk I think probably every news media has talked about it. So, but we just want to show you this chart. So based after when Donald Trump got hit by the pandemic, by COVID, you can see that the odds for Biden suddenly spiked up. So this is numbers on 2nd October. So the odds now is the highest since the whole betting, since they allowed betting to be allowed. I think you can see that this is the highest that Biden has ever been, and And so there's a high chance that Biden will win. And of course, if he wins, just a general comment, as usual, it'll be positive for Asian assets and Asian currencies. Okay, this one is just to remind, this is just our view that equities is still the best and most rational option for investors. So this chart basically tells you, because right now the the STI pays a forecasted 4% dividend yield. And then if you take that out, the bank paying you the 12-month DBS, roughly, because you can have promotions around, let's say 0.2%. For one year time deposit. So if you take that out, then that's how you get this slide. So the difference between putting your money in STI and putting in FD, you are getting about 3.7, 3.8% kind of differential or spread. So we think, firstly, the spread is attractive compared to during, it's never been as attractive as during the global financial crisis, which is the 2008 level. The one that you see in 2016, the one in the middle, the big bump, that was, as you know, 2016, the banks got hit by all the oil crisis, all the oil names. So what we think is, firstly, the spread between dividend yield and your deposit that you get in the bank is the highest since one of the highest levels, number one. And number two, don't forget that your dividend yield can grow. And because if you look at that, because a typical company only pays out 55%, only retains 55% of their earnings. So they take their earnings and they can actually grow that. And if you use the ROE, it's about 8%. And also also not to forget, this is forecasted. So this dividends, it already incorporates someone's idea of cutting the bank's dividends to 60% of last year's levels. So you're already also buying on quite, in a way, kind of compressed dividends. And in view of the economic conditions. Next slide. Okay, and then we move on to our stock picks. Next slide. Okay, in our event, we ran through almost all our stock picks, 20 over plus, but this one we'll just focus on our model portfolio. So as you know, this is our model portfolio of 10 stocks for the fourth quarter. The changes we made are in the red box. So what we did was we took out Ascott. I think the Ascott hit us quite hard. I think if you can see from the table on the right, the March, I think, which is no fault of anyone. COVID, who knew the thing could spread so much. So of course, Ascott was hit because of the hospitality, but with the way the pandemic the trajectory of the pandemic in Europe, so we kind of took it up because any recovery will be prolonged in Europe, at least in the hospitality or the hotel industry. So as a result, we took out Ascott and then we included Manulife. I think Natalie will explain more later. Then the second thing we took out was DBS. The reason why we had DBS was purely because the dividend yields, which was attractive at that time, maybe 5%, almost 5%. And then this is probably one of the highest in the region. So they were also attracting regional flows because of the attractive yield. But with what has happened, so we took that out and we think SGX is probably a better way to play the financial sector. And there's dividend growth for SGX and they also pay their dividends quarterly. And then the next change we did was we took out venture, not because of the outlook, but merely because we just thought it's a bit rich for us and the value, purely because of our valuations. And then we added in ComfortDelGro because of recovery. We'll explain later. Just one final point. The table on the right that you see is just our performance monthly. Obviously, we kind of outperform the STI. Most times we outperform the STI. But again, having an 8% return it's not a consolation because now you're not going to pay bills by losing money. So we will try and get back some returns and hopefully and try to improve on the performance of the model portfolio. And again, just one last note. The reason why we do this is also for transparency. No point coming out with our stock picks here and there and then talk about it in the press, but there's no accountability. So part of the reason we do this is just to give some accountability that if you have a buy, we can tell you whether we did well or not did well in as transparent manner as we can. Okay, I'll move on to the next slide. We'll start with Yoma and Che Hui.
Thanks, Paul. First, we have Yoma. Yoma is a conglomerate in Myanmar. It has 4 key business lines, namely property, F&B, motors, and financial services. The property business is the largest contributor to Yoma's revenue stream. In the property segment, it has a large property land bank, equivalent to 10 to 15 years of sale. The project in the pipeline includes the up-and-coming Yoma Central, Star City, and the Peninsula Yangon. Financial services are also poised for growth through its key driver, Wave Money. Just a bit of background, Wave Money is profitable and it became profitable within 2 years of inception. If you see the chart on the left, its revenue is up by 5 times year on year as of March 2020. This is attributable to its brand leadership and a large network of Wave agents in Myanmar. Amidst COVID-19, the over-the-counter transactions were impacted due to lockdown measures. However, its e-wallet business still continued to record double-digit growth rate month-on-month, accelerated by e-commerce. In June, Yoma actually announced an increase in stakeholdings to become a controlling shareholder. This creates opportunities for Yoma to integrate Wave into its existing property and consumer business lines. For the last point, the growth in the F&B segment is also underpinned by a 60% growth in KFC over the next 3 years. And this is actually just on store openings alone, excluding organic growth. Yoma is expecting the number of KFC stores to increase from the current 45 to 75 stores should Myanmar's economy recover. Amidst COVID-19, the F&B stores were hit due to the lack of dine-ins, partially cushioned by delivery sales. The target to open 2 to 3 KFC stores by the end of the year still remains unchanged, but the openings will depend on overall market conditions. In conclusion, we like that Yoma is entrenched in Myanmar's fast-growing and attractive consumer segments, and we find current valuations depressed in view of structural growth. We maintain a buy with a target price of 46 cents. Separately, we'll be hosting a webinar with Yoma this Wednesday on 7 October. Hence, do join us if you can. I'll pass my time over to Ned for Manulife USV.
Thanks, Xiahui. So our next stock in the absolute 10 is Manulife. We like Manulife because its portfolio is shielded from short-term uncertainty due to the long WALE of 5.7 years. And this long WALE, as you can see from the graph below, it actually means that there's a lot more long-dated leases. And that means that in the earlier years, FY20 and FY21, the number of expiries, or percentage of expiries, is actually relatively low at 4.4% and 6.4% respectively. So these long-dated leases actually also mean that a lot of the leases have written in rental escalation provisions of about 2% per annum within the lease terms. Manulife also maintains a high occupancy of 96.5%. The second reason why we like Manulife is due to the resilience of the office-using sectors. We can see that from the comparatively low unemployment rate in office-using sectors, as well as the low loan delinquencies of 2.2%. So this compares to the loan delinquencies of the hospitality type assets in the US at about 17%. The third reason for our preference of Manulife is the continued relevance of office space. So we think that physical interaction will be the most effective mode for mentoring collaboration, innovation, corporate culture. And this is seen by the graph below. So as you can see, collaborating has been on the uptrend from the years 2013 to 2019, and this is without the pressures of COVID-19. And while collaborating virtually has doubled from 7% to 14%, the collaborating in person means physically also has almost doubled. Yeah. So for this reason, we think that the office workplace will continue to remain relevant. So once again, our rating for Manulife is a buy at 90 US cents. So FY20 DPU yield is actually relatively high at about 8.7%. Our next counter is Fraser Centrepoint Trust. So we like Fraser's because of the resilience of suburban malls owing to the live-in population, which provides recurring necessity spending. So FCT's malls are suburban malls, and they are located along very near transportation nodes in the heartlands, so in the suburban area. So these transportation nodes are like MRTs as well as bus interchanges. Because of this live-in population, a large percentage of the tenants are actually from trade categories that are deemed essential services, such as your F&B services, supermarkets, as well as your beauty and health type of tenants. So we believe that this they will provide a recurring need for this kind of, the living population will actually require such a recurring trade mix. Second of all, FCT's largest malls, which are Causeway Point, North Point, and Waterway Point, if you look at the graph below, they are dominant malls in the north and in the Punggol area, and they will benefit from the growth in the live-in catchment population from the projected 67.7% jump in HDB units surrounding the malls. Additionally, Causeway Point and Waterway Point are also beneficiaries of the URA master plan, which will actually seek to make Woodlands and Punggol vibrant economic hubs. So post After attainment of the unit holder approval for the acquisition of the remaining 63.1% stake in ARF Fund, this will boost FCT's suburban NLA by about 80%. Yeah. And the accretion from this transaction is actually about 4.8% for FY21. Lastly, the same way how consumers actually tend to use credit cards to accumulate points, etc. We believe that FCT's digitalization efforts to build tenant and customer stickiness through their loyalty program, which is Fraser's Experience, as well as their e-commerce and food ordering platform, Makan Master, and the e-store, will actually help to drive tenant sales and build tenant stickiness, as well as customer stickiness from encouraging customers to actually amalgamate their purchases within FCT's malls, your food, your groceries, your electronics, whatever, as and when they have these needs. Yeah, so this will help to drive or give these larger operators, more operators, a better chance against fighting against the small operators. So just one last point to note about FCT. They have launched a preferential offering. This is to fund the 63% increased stake in ARF. So for those of you who are unit holders as of 2nd October, this preferential offering is open to eligible unit holders who hold shares as of last Friday, 2nd of October. So eligible unit holders are those who have a registered Singapore address. So that means those who buy shares via your own CDP as well as from a custodian account, and the custodian has to be a Singapore local broker. Yeah, you'll be entitled to subscribe for these shares, and for every 1,000 shares, you will be offered 290 shares. Okay, that's all for FCT. I'll move on to the last counter from me, which is CapitaLand. So CapitaLand currently is trading at a relatively attractive price, 43% discount to RNAV. And we like CapitaLand because of its diversified real estate portfolio. It is diversified and it has categories such as retail, commercial, offices, as well as hospitality, industrial, and residential. So because of the diversification in portfolio, they are able to better mitigate the economic cycles. Second of all is the high percentage of quality recurring income. So for 1H 2020, about 69% of EBIT was actually from recurring sources, such as your investment properties and fee income. So of course, this percentage of recurring income was higher in 2019. It was about 90.2%. So we like that a large portion of revenue is actually recurring in nature. So this actually helps to mitigate the lumpy revenues from the development segment, your residential development segment. CapitaLand has also experienced very healthy recovery in residential development sales in China, and the sales have been maintained a very good take-up rate as well as pre-COVID prices. Because of CapitaLand's experience in the real estate space, they are quick to pivot, and we have seen this through CMT's digitalization of the retail business, similar to what FCT has done with the loyalty programs as well as the launching of the e-commerce platforms. Okay, so that's about it for CapitaLand. Our rating for them is a buy. Moving on to Wee Kuang for SGX.
Okay, thank you, Natalie. Okay, the next counter on the absolute 10 is SGX. Generally, we are positive on the growth prospects of SGX, and that is underpinned by the stability of the current business. So if you can see on the bottom left-hand table, in 2020, trading volumes of our SGX was up 40% year-on-year. And based on the latest data, if you take a look at the bottom left again, we see that SDAV for the first quarter of 2021 for SGX itself is up about 16% year-on-year. We don't have the derivatives data yet, but based on just equity derivatives product, it does seem like the derivatives will be positive year-on-year in the quarter ending September as well. As such, for the first quarter ending September, we believe SGX will see revenues higher than 1 year ago. Yep. In terms of growth, we also seen SGX undertake some acquisitions and licensing agreements over the past few months. So in the first half of the year, they acquired BitFX, they acquired Scientific Beta, and their licensing agreement with FTSE to replace their expiring MSCI license will benefit them as well to replace all their expiring contracts. As such, we expect revenues to increase 10% year-on-year for financial year 2021. Small point on dividends as well. SGX actually recently increase their dividend from 7.5 cents per quarter to 8 cents per quarter, and it seems like a stable and conservative kind of increment. So it's nothing that they have to cut back on anytime soon, and they are not under any regulations to do so. But unlike the banks compared to who needs to address concerns by the MAS. So overall, generally just underpinned by very good fundamentals with a very good growth outlook as well. And we have an accumulate rating for SGX with a target price of $9.45. Yep, and that's it from me. I'll hand the time back to Paul, I think.
Yeah, okay, thanks, Bee Kwong. So we'll move on to the remaining few stocks. Asian Pay TV. Yeah, I know it's not the most popular, and please don't leave after this. Okay, basically, Asian Pay TV is, as you know, is a cable TV operator in Taiwan, and the only way to watch TV, those local channels, one of the only ways is actually their cable TV. So I think for $16 per month, you get 100 channels. So the two reasons why we like it, of course, the dividend yield is high, and more important is whether is it sustainable. So in the past, they got hit. I think what has happened, as you can see on the red line, the red bar, they were paying dividends far exceeding the free cash flow. And what happened was that beige line that you see, the capex line. So they were asked by the authorities to basically install an additional set-top box. So they're basically like a StarHub, but the only thing is that they're the only one that can provide cable because the competitor is ADSL. So what they do, and they don't have the pay TV channels. So what they did was the cash flows, despite the increase in the capex, as you can see, the capex, that orange line used to be maybe 70, then hit to 100. Because they were asked to put in another set-top box. But you can see the blue line didn't really grow. It kind of almost turned flat. And as a result of that, the dividends was not sustainable. So in a way, they really did not get much return on the capex. So that's why the red line continued to exceed the free cash flow until they had to cut it. I think the big drastic one was in 2019. They just had to cut the dividends, and then to make it more sustainable, so that the blue line, which is the free cash flow, is now more than the dividends, and they can make it sustainable. So right now we think that the dividends are more sustainable. And also the second reason is that there's optionality. You can see the bullet point B, there's optionality on a high margin. So once 5G license has already been awarded early this year in Taiwan. So what they're going to do is, as they start to roll out, they will need to connect to all the base stations, and then you will need fiber. Of course, you can still take it, but you're going to take it to an immediate competitor that is which is Chunghwa Telecom. The second bullet point, just one last one, the cable TV subscribers. So what has happened is the total subscribers for them was declining, but right now it started to recover and improve because there's a rise in broadband subscribers offsetting the cable. So they offer cable TV, which is like your pay TV. But most people watch local TV, so your content cost is much lower. And also, secondly, they offer broadband services through cable. Next one is ComfortDelGro. So the reason why we like it is the first bullet point, they're going to be the immediate beneficiary. I think as you see things starting to lift up, group gathering, so there'll be more people traveling to meetings, number one, no more people traveling for religious reasons, and also classes, and basically more activities, more meetings, more conferences. So these things we think will slowly start, you will see the activity start to pick up and transfer patient move. So they're more immediate than, if you compare to airlines, which is take another 1-2 years before you see anything. So we already started to see the numbers moving. I don't have the chart here, it was in another slide, but you can see that the number of passengers being carried by taxis has been recovering. Then of course, and the stock is really down 40%. So even on the path to recovery, I think they can claw back some of the losses that they experienced this year. The second bullet point is they are grabbing some share. Although it's not like some huge 10%, but it's still 60%. And like we always say, it's not easy to find any company that has 60% market share in taxi and also in the bus services. The third bullet point is just that they did a lot of rental relief. I mean, they were subsidizing. Basically, the taxi drivers need not have to actually pay any rental, but this will all claw back. There will be still some in the September quarter. By fourth quarter, there won't be any, there will be very minimal rental relief given. Then the next one is the new real contracting. So this one I really no idea when's the timeline, but if they move to real contracting, whereby you just, where you don't have to come out, don't have to take the passenger risk. As you know right now, all the travel, if they take passenger risk, so that if there are less travelers, there's less revenue for them. So they could do like a bus contracting model. The next thing is that the industry, actually the taxi fleet, the only thing is that the taxi fleet is still contracting. So that is the only thing that holds us back from like a very long-term buy until that kind of is arrested. This will be more like a kind of trade to claw back some of the 40% that they lost this year. So this is the rating and accumulate and a target price of 165. Next slide. Okay, next one is Propnex. I think we talked many times about this, but again, just to reiterate, as you know, Propnex is a real estate agent. The first bullet point why we like it is the dominant market share. I mean, like 50% market share. So any new homes that you buy or your developer sells, one of it actually comes from a Propnex agent. Volumes will be weak this year. I think it'll be down 6%, but I think the third quarter, it's like the June quarter was very bad. I think June quarter volumes, that means the new home sales and resale dropped 40%. But I think third quarter, it's kind of flat. I mean, down 1%. So at least there's some recovery. Then the results will be weak. I think because the third quarter will kind of reflect the second quarter numbers. We like the attractive business model. I think ROE of 25 million, and then there's hardly any assets used. I mean, fixed assets of 4 million to make 20 million, probably like 2 Mercedes or 3 Mercedes-Benz. But okay, the second thing is they actually increased their dividends in the first half, and then we think the 7% dividend yield is sustainable, and more important, the management wants to try to keep them like a high dividend paying stock. So to keep that 7% or 6% dividend yield, you need like 15 million cash to pay, and they got like 100 million cash in the balance sheet right now. Of course, a bit extended because one part of the dividends, because the AGM was delayed, right? So they kind of couldn't pay the earlier batch of dividends. Okay, last one for me, I think is Thai Beverage. Again, the reason, mainly two reasons why. Firstly is basically the valuation, the third bullet point. They historically trade at 18 times, so we think that there's this thing can rebound back to their historical numbers, number one. And number two, the government is stimulating the economy through cash handout and salary subsidies. And then number three, I know there's some questions on the protest. Again, I mean, like we always say, you can probably ask your neighbor, probably have a better view on Thai politics than me, because we all just read the newspaper. But so we actually did check with our strategies and research team in Thailand. We got quite a big team in Thailand. So their feedback to us was just that so far the protest in Thailand has been confined to the young. So you don't really see a really mass in other segments of the population protesting, and they don't seem to be that organized yet, or at least maybe yet. So the request from all the protesters is like all over the place. They want this, they want that. So they are not really organized enough yet to be a meaningful threat to the economy. Of course, there'll still be a lot of political noise, but for us, we are, I guess, two-dimensional. We just want to see what's the impact of the economy. So it hasn't really hit the economy, and the government is trying to offset these protests with a more aggressive government's stimulus. Okay, the last one is just Sabeco, the second bullet point. That one is problem. Sabeco will be an issue for the medium term. I think this drink driving, even on bicycles also, they'll ask you to pay penalty if you drink. So it'll be quite challenging. Okay, and then just some conclusions. We think that there won't be much earnings momentum. I think it will be a snapback, then will be very slow year-on-year growth until we really totally open up. But the thing is that interest rates will be low, and our strategy is just revolving around dividend yield. I mean, this is Singapore market, right? So it's all going to be heavily centered around dividend yield. Okay, thanks. Next slide. I think we will open up for questions.
Okay, I'll start off the Q&A session. I think quite a lot of questions for me on IX. That's good to see. First of all, but I'll start off with a banking question. I think there's a question on whether it is a good time to buy bank shares as they are trading at recent lows. I'm not sure whether asking about TA or FA, but just to provide a view from the FA side. I think from right now, the banks itself, they are facing some headwinds. So overall, there's just three main key points. First of all, interest rates are low. Definitely, with all their business model having about more than half in interest income, you can expect some headwinds in the short term. They will recover, but they will not recover to pre-COVID-19 levels. So that's the main point. And secondly, they are providing for additional allowances over the next 2 years, as we know, because of the fallout from COVID-19, the economic fallout from COVID-19 itself. And this accelerated allowances increment, right, year on year, not just will definitely hit their earnings. So definitely it will just take away from their bottom line. And that's second. And lastly, is because of their dividends. The dividends being kept by MAS itself is something that's not going very well for them, because even if they are earning money, you won't get the returns as an investor in terms of dividend yield, right? But the good thing is that what we are banking on is a recovery, because right now they are doing all they can to increase their allowances. We are waiting for the point in time whereby the banks come out and say like, oh, now that all the loan moratoriums are all over, that is contingent on them letting the moratorium end. So that itself will allow the investors like us to know exactly how bad the non-performing loans have become during the COVID-19 period. Because without them expiring, right, you can't see people default. Yeah, because there's no default during this period of time. Then that will be the key thing. If they come out and say like, oh, the loan moratorium has ended, but everybody is healthy, they are all paying back their interest and everything, then that will be a good point that will see the banks shoot up in the short term. However, it might go other way, because right now the banks are in talks with MAS again to see whether there is a need for loan moratorium to be extended, even to a smaller extent, just for those that are more in need. So that one we'll have to wait out, and we'll probably know more towards the end of the year itself, as the loan moratorium start to expire in December. So that's for me, for the banks. And then I'll talk about IX. I want to talk about IX. Okay. So for IX, first of all, I think there's a question whether it is currently profitable. No, they're not currently profitable. I think for the past financial year, 2020, they had a loss of about close to 10 million. Yep. However, what we are banking on is that they will turn around and become profitable. And that goes to the next question. I think one of the top voted question is a big jump for negative gross to a positive gross margin for IX Biopharma. So the question is how probable is that scenario? Currently, they noted that the R&D expenses is double that of the revenue, and total current expenses is about 8 times of sales. So that is all very legit. That is also something that a problem I faced when I was trying to understand the business. And from what we know is that actually for them, a lot of their costs actually is kind of fixed. So we try to address it one by one. First of all, the R&D expenses. So they were banking very heavily on their Wafamine, which is this ketamine product. Right now, the out-licensing deal will allow them to enter the US market. And as we know, right, US market in terms of pain management, you have the current opioid crisis. And ketamine is a non-opioid. So it will definitely be a much bigger demand compared to what you see in the market, because people are skeptical about opioids. And if they are able to come out and say, oh, I have this drug that can treat pain as well as an opioid, and that's definitely going to gain traction very fast. Of course, the commercialization period will take a while, but their licensing, once it is done, what we have catered for the first year is already an $8 million upfront fee. So this will be the thing that pushes them to profitability if it comes to fruition in financial year 2021. And for the other parts of expenses, sales and marketing, of course, generally they are fixed. A lot of them, a lot of the expenses are actually fixed in nature, whereby there's like overheads and there's also manpower costs. And they are not expecting these to fluctuate much moving forward, even as their sales increase. Even for their general and administrative fees, they are generally expecting it to be relatively stable or even clip off a bit, because I think in financial year 2020, there were some one-offs that were recorded up to about 500,000 because of the whole end of phase 2 meeting with the FDA previously. And I think, okay, for R&D wise also, they were banging so much on WaferMin. So once WaferMin is out of the way, they are not expecting R&D expenses to be incurring at the same rate as they were over the past few years that you see. So moving forward, right, because right now is they have to do this because it's a show of their own technology. It's a showcase of their own technology. Previously, their technology was implemented on WaferSeal, which is their erectile dysfunction drug. So right now, when they are entering into a much bigger market in pain management, in ketamine, this will be the thing to push them in terms of their reputation in the entire pharmaceutical industry that, hey, their WaferX technology is the one out there in the market that will change the game. And once they're able to do that, subsequently, they do not need to incur as much R&D costs because any potential licensing partners will be willing to bear the cost because they know that, okay, this WaferX technology is good. They don't need you to go through the trial yourself. I can come in, be a licensing partner to you, and I'll bear the cost. So the cost will be outsourced in a sense. And so for us, definitely, and that is notwithstanding their increase in capacity in the upcoming year. So what happens is that if you look at just the revenue number again, if I were to let you in on how I kind of forecasted my revenue numbers, first of all, we take their past quarter revenue, and then you just a simpler multiplication, okay, cost times 4, but I did some discount again. So you will have roughly about 2 million, even not doing anything. That will be their revenue for this financial year, just a discount. And then in the second half of this year, which is going to start from January, imagine that their capacity is going to increase 6 times. I'm not even assuming that, oh, it's going to be full capacity. I'm just taking a haircut again. And then my revenue forecast of about $3 million, $3.1, $3.2 million, plus the $8 million in out-licensing fee will be more than enough to bring them to profitability. And I am being on the more conservative side. And also that is assuming that a lot of their costs their cost control measures are in place. Otherwise, we are forecasting them to really go full-blown profitable in financial year 2022. So definitely, discounter-wise, if you are looking to buy, hold it. You will look for the prospects in the next 1 to 2 years. Not in the short term, definitely. And that's, I think. Let me see whether there's any IX. So all the IX questions, I'll answer them all together. Whether we will consider a guest presentation, no problem. We can look to that. We can try to arrange something with IX Biopharma. I'm sure a lot of you will be interested as well. And let me see. Okay, then there's another question for IX Biopharma on their WaferX. What are they up against in competition? And what is their position with FDA approval? In terms of their WaferX technology, there isn't really any competition out there. So you can see their patents are currently being granted all over the world as of right now, showing that actually no one else is coming up with something similar. There's nothing similar out there in the market in terms of sublingual drug delivery system. And even for just like WaferMin, like I was saying, the nearest competition that they have is an opioid. I forgot what was the drug. But it's an opioid. So in a sense, being a non-opioid itself with much lesser risk of overdose and everything is a key game changer for them. And what is their position with the FDA approval? I think, so generally now they have finished, after the talks with FDA end of last year, they already know what kind of scale, what kind of details they need to go through for the phase 3 of clinical trials. So what they are really looking out for is really for a company to come in and say, I will take it from here on. And there are a few potential partners that they are considering, but generally, like what I was saying, it's all in talks now because a lot of I think in terms of urgency-wise, everybody is all looking at COVID-19 vaccine right now. And I think, I think that's it from me for IX Biopharma. Maybe let's see what's the next question. Maybe I think it will be back to Wei Ren for Mapletree.
So thanks Wei Guang. So I think Mapletree commercial trials, unfortunately, I look at it. Basically, let me share my screen first. Guys, let me share my screen first. Okay, so yeah, Mapletree Commercial. So Mapletree Commercial currently is still very ranging. Okay, compared to commercial trust, I mean compared to industrial and logistics trust, I think again is current ranging. So not much not much technical action ahead. So I rather you look to the logistic and the industrial trust actually. But I hope that answers your question. Thank you. So the next one I think is for Natalie. So what's the group price target to accumulate Ascendas Street for long-term dividend yield? All right, Natalie, back to you.
Hi, thank you for the question. So actually, I think over the last couple of months, Ascendas has actually pulled back from its high. So actually, currently the total returns is actually quite. Sorry, let me see if I can find the actual total returns right now. Based on our target price of $3.63, total returns about 11.7%. So for industrials, the kind of dividend yield at this entry price is about 4.9%, which is considered quite fair for Ascendas. And given the recent pullback, I think that the current price presents a good opportunity to actually start accumulating. Not to mention that Ascendas actually just off. Since 2019, they ended the year with several acquisitions, discussion, negotiations in the pipeline. So those plans and those discussions have been, sort of paused for during this whole pandemic outbreak, and the recovery in share price and opening of borders. I mean, not all the borders are open, obviously, but as they gradually open up, we can actually we can expect these deals to continue. The negotiations for these deals to continue. So this is not priced in yet, the potential acquisitions. So long story short, I think the price right now is a good time for you to start accumulating, and that we can expect a possible upside surprise. Okay, thank you for that question on Ascendas. I will take the next question on FCT. The question here is, FCT seems promising, however, share price seems to move up quite a bit, i.e. valuation seems relatively richer than CMT. Would CMT be a better alternative to long at this point? So I think there are reasons why Frasers seems to be more expensive presently compared to CMT. So as mentioned, FCT is actually, their portfolio is predominantly suburban malls. So suburban malls, even throughout the pandemic, they were relatively stable. It's not stable actually. Okay, about 20% of their tenants were operating as compared to central malls. As we know, central malls were very badly hit, especially with zero tourists coming into Singapore. So even throughout the circuit breaker period, the suburban malls were the ones that were sort of doing better. And even presently, as we speak, since July, the shopper footfall and the tenant sales have actually almost reached pre-COVID levels. Whereas, as we know, because of the lack of tourists in the central malls, and the borders are still going to be largely closed to leisure travel. So that is going to be weighing down on the share price of CMT. Yeah. So I guess what I'm trying to say is that the difference in valuation, there's a reason for it, and we like FCT because I think we prefer stability and visibility versus like your surprise upside. So that being said, yes, of course, if CMT is able to bounce back even more strongly, then that will be the potential upside for CMT. I don't know if I should continue taking some of the questions or
can
pass it back to Wipeng first.
Yeah, first break. Thanks. Okay, next question. I'll just take some banking questions. Okay, first of all is what is your view on OCBC? Okay, so generally like I mentioned, the three banks are all facing the same kind of headwinds. But for OCBC wise, again, the main differentiating factor between them and the other two banks will be, first of all, is Great Eastern. Great Eastern wise, as long as the market is doing well, I think their investment holdings should perform okay. But this can all change very suddenly. As we know, they were very affected in the first quarter because of the COVID-19 outbreak. Then now, although it has stabilized, we are not really sure. It's very hard for us to pinpoint like, oh, the market is going to do well, so OCBC, Great Eastern will do well, and therefore OCBC will do well. So it's like too many links to forecast, and that is one thing. And the second thing is that there will be some price pressure in a sense. If you take a look at it, the current existing shareholders, they are going to get the dividends, the share dividend option, which is very attractive. So as long as they keep subscribing to this share dividend, right, then that might put some price pressure on OCBC itself. But of course, on the flip side of things, is that when they actually choose to take their dividends in shares, they will be able to accumulate more and more capital because they save on their cash. And then when they actually exit from COVID-19, then they might have excess capital that will help them to buffer their CET1 levels, and hopefully they will be able to reward the shareholders. And yeah, just to reinforce again, OCBC is the only one with a share dividend scheme that offers a 10% discount compared to the market, as opposed to UOB and DBS, which is like a 0% discount. Basically, you're just, when you opt for your dividends in shares, you're just getting it at the market price almost. Yep. And I think Wei Ren will have something to add on for the TA side of things.
All right, thanks, Wei Guang. So I have a full suite of charts over here based on the Q&A asked in. So okay, so I'll start on with OCBC. I'll just add on. I think OCBC is still going to on the sell, going to make lower low. Okay, first, but it's still kept well within the range, because first of all, the dominant trend is still very much bearish. And then the second thing is, although there's a breakout of the downward trending slope, there's a false breakout, because first of all, you look at it, is actually maybe is a potential flag. Despite opening higher, I think the sell down was quite strong for OCBC. So if it persisted this until 5 p.m., I think tomorrow there will be resume the sell down, because it's actually a potential dark cloud cover. Then the second thing is support is actually weakened. So right now we have another tested. We have the fifth. We have the sixth support zone being tested. So it's actually kind of weakened already. Any upside will see $9 being tested and then not being broken actually. So I think in the long run, in the midterm, I think downside within a range. All right. So that's for OCBC. DBS, I think someone asked about what's the support. So theoretically, I think this is a resistance. Let me change the color. This resistance zone most likely will be tested again. All right. And then the next resistance zone will be at actually $22 region. Let me get this away. All right, so it will be $22 to 22.01 to 21.75 region. So this likely to be tested again. If broken, then this one will be tested. Long-term buying support zone still returning back to the $20, below $20 region. Likely $18 to, I think $17, higher of $17 to $18.45. All right. So next one, I think I'll answer CapitaLand and Capital Mall Trust. So Capital Mall Trust, I think I foresee a pullback until the support level at 1.81 to 1.80. If there's a strong breakout, then 1.77 will be the likely rebound region. Okay, this level. 1.73 to 1.78 will be the likely rebound region. First of all, I think if you look at my report, I think on the 1st of October, last week, I think last Thursday to be exact, or Friday, I can't remember. That I call a short because there's a head and shoulder over here on the upside, and then rejects $2. I think the $2 has been failed to close above, and the right shoulder failed to close above the $2 once again. So I think there's a continuation downside despite a pullback this morning. All right, unless $2 has been broken up strongly, then we'll see the resumption of uptrend. Otherwise, I think this rebound will be the best zone. Then I move on to CapitaLand. CapitaLand is much more of a dilemma. So first of all is it has a very strong resistance at a 50-day moving average over here. Currently it's very much ranging, and then we are looking for a downside actually to $2.60. So what's the dilemma is because price is still trending above $2.60, but due to the weak momentum, I think we might see a retest of $2.60 again. All right, so I hope that's that I can answer your question. So the next one will be iFast. So iFast, I think iFast have been going on very strongly, but currently we are facing an expanded flat, corrective flat pattern. So it's A, B, and C. So a high chance that iFast is going to break a higher high. I mean the resistance, but there's a falling wedge. So the regular flat pattern. So once it clear above here, I think around 250. If the 250 is reversed strongly, then we'll see a potential downside to $1.90, and then therefore after that continue a rebound thereafter. So that's for iFast. And then do you mind if I clear everything? Okay, so I think someone asked about Jaffa. So Jaffa, it has a falling wedge out of the dominant upside bull channel, bullish impulsive wave. He has fulfilled all the five, 2 on the downside, 3 on the upside, but this candle is still poses a challenge. So after that, I think during an intraday, I think you need to have the upside to continue to confirm the breakout of the falling wedge. Otherwise, if it's not, then you'll still range further to 0.55 before a rebound. All right, so we shall see. All right, for Jaffa. All right. So micromechanics. So micromechanics is very strong uptrend. Third wave has been completed, so we are on the fourth wave. There are 2 theories. We might see a 5th wave, or if this one is going to break up immediately, I think by end of this week, break off the resistance zone very strongly, then we'll see extended 3rd wave instead. And then we'll see that the upside will be therefore prolonged once again. All right. That's for micromechanics. OCBC I've done. Then Mapletree Commercial Trust, and then last one, I think someone asked about SATS as well. SATS as after the head and shoulder, after the rebound over here, I think I did not foresee this very strong up move after the pullback. So, but I think that it's still entrenched within a very strong downtrend. So I think the next level to be shorted, to be tested, I mean the resistance zone to be tested is this $3.31 to $3.38. All right. So I think that's all for me. I think I'll pass my time back to my colleagues. If there's any more technical question, type in the chat, and then I'll try my best to answer if there's still some more. Thank you.
Yeah, I see this question. Well, Philip, money market fund Sing dollar ETF. What is this? Okay, I haven't been briefed on it. I probably have more questions than answers, but let me tell you what I know. So this is a ETF. So it will replicate the SAW, the Singapore swap offer rate. Okay, don't worry. I know like most of you may not know what it is. Sometimes I also grapple to understand what the SAW is. But okay, and you think of the SAW as the difference between the US dollar short-term rates and the Singapore dollar. So example. If you, let's say you, US dollar rates, let's say 3-month rate is 1%, then Singapore is, then the US dollar is 1%, then the Singapore interest rate is usually higher, so 1.5. So SAW is the difference, is that 0.5. So in a way, SAW will also reflect the movement in exchange rate. So if the Sing dollar is going to weaken, then obviously I want to be compensated more than just that 0.5 in difference. So this MMF ETF, in my own view, I mean, I've not been briefed. The way I see it is, firstly, the rates are low. I think the SAW now, 3-month SAW number 1 is only 0.16%. So I don't think, and people might want to buy for that return. And the second thing is, so the way people might buy the MMF ETF, if they take a view on interest rates, obviously in Singapore, and offer the exchange rate. So if you think Sing dollar is going to weaken, then the SAW should actually increase, and if that happens, so I think the prices of this ETF might actually come down. But that's what I think. I mean, I've not really got brief. I need to talk to them and really get more answers. So this ETF is a way to play interest rates, and also in a way the the appreciation of the Sing dollar, but of course it's not as volatile, I would presume. So I couldn't really answer it totally, but what they will do is they will take the money that is raised from this ETF and they will park it into this swap offer rate, which is right now about 0.1, roughly about 0.17%, the 3-month. But again, the other complication is in 2 years' time, the Singapore banks are moving to SORA just to make life more difficult. So then they have to see how they're going to transition, and there's no historically how does SORA actually move. Okay, sorry, I got more questions than answers for you. Okay, I'll move on to the next. I think next is for you, Natalie. Is it your Moody's downgrade?
Yeah. Okay. So the question is, what is your view on Moody's downgrade on CMT? So just for the benefit of everyone, last week, I think probably Thursday or Friday, Moody's actually downgraded CapitaLand Mall Trust unsecured senior unsecured rating, basically from A2 to A3, but then they upgraded CCT's issue to a higher rating, basically one notch up. So they apart from the change in rating on the debt of CCT and CMT, they actually also downgraded the outlook for CMT from under review to negative. And this, according to Moody's, they say that they have, in coming up with this rating, change in rating, they actually did take into consideration the enlarged CMT's enlarged and more diversified portfolio post-merger with CCT. And the outlook actually reflects the uncertainty surrounding the extent of the coronavirus-related disruptions and impact on earnings and performance of the retail properties. So another main reason for this downgrade in outlook is also because of the almost $1 billion debt that CMT will have to take on to fund the cash portion of the cash consideration. Of the purchase consideration. Yeah. So, however, while what Moody's said is valid, and that even though our opinion is that the diversified or the enlarged REIT, which is the combination of CMT and CCT, would actually be beneficial as the scale provides some stability. However, we do note that because the office sector, as well as some components of the retail sector, especially some of the central malls under CMT's portfolio, those are more cyclical in nature. So it might, there's some risk coming from that side of things, the cyclicity of the counter. Additionally, another point to note is actually, despite some weakening in the interest coverage ratio, or the earnings to the debt to earnings, it's actually the difference is actually very subtle. So we don't really foresee that to be a risk going forward. So I hope that answers your question. It means that we see where Moody's is coming from, but we do not really think that will affect the prospect of CMT. The risk is will be counted in will be in our discount rate. Yeah.
Hi everybody. I think we will take one more last question by my colleagues. So because we got a webinar at 1 p.m. With me and Chin Rong doing the US market. So Paul, do you have anything to add on for the last question? If there's any, thanks.
Oh, okay. So we'll just do one last one before we end, because I think we don't want to trip into Weiren's time. If you have the questions, just post it sometimes in our community page. We can answer them there. Anyway, on micromechanics, the new growth driver, I think for the first time in the most recent results announcement, just two things. They announced that they have a new customer parts, and not only just one part, multiple parts on the front end. They never really touch who did, but if I were to venture a guess, they never really tell me. If I venture a guess, it probably could be applied materials. That could be one potential customer, because applied materials now, as you know, is outsourced quite a lot of their business, and regardless, I think even if this is not material, this stock is still paying you, I think right now maybe 5% yield. So you're just getting a 5% yield, and even if this thing don't take up and the existing business is running, there's a lot of safeguard in it. I mean, even if this thing is not as material as we thought, or it can this company can still pay you a 5% yield, and the semiconductor cycle has kind of bottomed out and turning around. So that's why it's almost like a relatively lower risk way to play semiconductor. But again, the volumes are thin. So this is just like a big bonus, a very high likely big bonus that you will get from this. So yeah, and they did raise the dividends 20% this year. Okay, I think we don't want to take up too much time. Thank you everyone for attending. Just go to our Stocks BNB page and just type some of the questions. And the good thing about having a community page is that it's really there, so we've got no choice, we have to answer you. And also feel free, and hope to see you again next week. And if you do still tune in to our two listed company webinars, and also later Weiren will be, and the US analyst will be talking about the US elections. Okay, thank you everybody, and I hope to see you next week. Bye-bye.